Welcome to this month's Economic Update. I'm Sinead Rafferty, Portfolio Specialist at NAB Asset Management, and I'm joined by our Senior Economist, Bob Cunneen. Welcome, Bob.
Thanks, Sinead.
Bob, we've seen mixed performance in global share markets throughout the last couple of weeks. US markets performed very strongly, up almost 3%, whereas negative returns out of Asia and Europe. What was the reasons behind this divergence?
Well, in the case of Wall Street, that strong performance reflects very robust corporate profits. So American corporate profits for the June quarter up 25% over the past year. So that's an extraordinary run. Against that, Asian and European markets are worried about President Trump and his raising of tariffs. In particular, if you're a German car manufacturer, if you think of Audi and BMW or Mercedes, President Trump has threatened to put a 25% tariff on these car exports. And because of that, it's very problematic for the German car industry. In the case of China, China's very sensitive at the moment because President Trump has already implemented tariffs on 50 billion worth of Chinese imports and is proposing another 200 billion of imports with tariffs. So from the point of view of China's growth, and in particular its export markets, it's a difficult environment, and hence Chinese shares are down close to 4% for the month of August.
Okay. What about other emerging markets? We've seen a lot of volatility, particularly in Turkey and Argentina. What are the reasons behind that, and are we worried about a contagion effect?
Yes, we are worried about a contagion effect because one of the key lessons of the global financial crisis 10 years ago was that even small components of the global economy matter, because the linkages between these small components can be magnified across the world economy. So each of these emerging market nations has individual problems, but the common link between them is that they are sensitive to their foreign debt burdens being priced in American dollars. The lower their currency goes, the higher the interest rate that is charged on those debt burdens, the more precarious their position is in terms of meeting their commitments. And that's what the market is worried about, whether Turkey and Argentina will be repaying their debts. So that is a concern. Hopefully we'll see some resolution over coming months to these individual problems.
And is that one of the factors behind the fall that we've seen in the Australian dollar in recent weeks?
Yes, it's one of the key reasons why the Australian dollar has fallen. So we've moved down from 74 cents down below 72 cents against the US dollar. And what we see with the Australian dollar, it's like a global risk barometer. So where we have problems in the global economy, typically the Australian dollar weakens because we have a very liquid, accessible currency, and where investors are concerned about emerging market nations but do not have the liquidity to cover their exposure, they use the Australian dollar as a bit of a hedge. Also, the Australian dollar is sensitive because we're a major commodity exporter, and in the case of Argentina, which itself exports wheat, we actually need a lower currency to compete with Argentina on equal terms.
Okay. And what about the Australian share market? How has that performed in recent weeks?
Well, the Australian share market did a remarkably resilient performance. It was up 1% for August itself. But we have to bear in mind there were a couple of sectors that did extremely well. So communications was up about 13%. And we had a merger announcement between TPG and Vodafone that was driving that sector. What we also saw, information technology was up 12%. However, our market was held back a little by what happened in the resources shares. They were down about 4% because of the weakness in commodity prices.
Thanks for your time, Bob.
Thank you very much, Sinead.
And thank you for joining us. If you'd like further information, it's available on the website where you launched this video.